Trump tariffs 2.0 relative to what we saw in the first Trump presidency is very different. I think, in the first presidency, really most of the trade negotiation was really centered around China. This time it's become pretty obvious that it's not just China in the crosshairs of the Trump administration. It's, every country, particularly countries that run big trade surpluses. The second major difference is it's not focused on like a narrow set of goods. Again, it's a lot broader in terms of all categories of goods. Even recently we saw them look at the de minimis rule for imports of Chinese consumer goods coming into the US. So I think that's the second point, that not only is it all-encompassing in terms of countries and regions, but it's all-encompassing in terms of the types of products that could potentially face tariffs. In terms of the actual rates, again, it's a moving target. It's not evident yet where we're going to end up. He started with obviously 25%. Then that was sort of retracted. They started with the de minimis package tariffs. That was retracted. But he has announced that he's looking at 25% across the board in multiple countries. Now, nothing's actually that clear at this point in terms of where we end up. As we know, Trump uses a lot of tariffs in particular as a policy tool for negotiation. So where we end up in terms of the actual rates, the actual goods, the countries that are more affected, is still yet to be determined. From my perspective, I'm looking at what's the objective of this. It appears to me, if you look at where Trump has been focused in terms of what his objectives are when it comes to tariffs, he's announced, obviously, the External Revenue Service as a new department for raising money. He's also looking at cutting lots of costs within the federal government itself. So when you put all these things together in terms of the types of policies across the board, it would appear that the tariffs are a way to raise money. So a revenue raising exercise, if you want to put it like that. And he views that the rest of the world, in terms of trade surpluses against the US, and the ability for even the end consumer to pay slightly more for goods. As we know, inflation really in the US is not driven by goods, it's been driven by services. So he views that if people have to pay slightly more, it's not going to impact the consumer's wallet too much. So let's talk about the impact of tariffs on the broader regions, if you want to put it like that. Again, coming back to the first point, which is, the tariffs are looking to be implemented across multiple regions, multiple countries. That's where it's different from, Trump 1.0. Trump 2.0 is really, it's a broader subset of countries, goods that are looking to be tariffed. From that perspective, it's not clear yet who's going to be the most affected. Is that EMEA? Is that Europe? Is that some of the specific Asian countries like China? That's yet to be determined. But the way it looks, and if the tariffs are really a revenue-raising exercise across the board, then I think it's going to affect everyone more equally. So there's not going to be I don't think, any clear winner by geography or region or country in terms of what these tariffs are about, who they're going to be applied to. I think it's going to be more universal, where everyone is actually affected to some degree. So when we look at potential effects on countries per se, at current rates that are being proposed from a tariff perspective, I think the base case has to be production won't be moved. Tariffs are also something that can be reversed. To move production takes a lot of time and effort, and it has to be a long-term, process. So at the current rates that are being proposed, I can't see production being shifted too dramatically anywhere, particularly when these tariffs are going to be applied to lots of different regions. And the US has to be careful that the rates that are applied don't lead to another bout of inflation, which obviously they're trying to get under control because interest costs where US debt currently is a factor. So even at current rates, even if rates that are a little bit higher, I think the ability for the US consumer to absorb, particularly on goods, is an offsetting factor in all this. And the fact that these tariffs are being applied globally because it's a revenue raising exercise also means that production is unlikely to shift dramatically because of them. So that would be my base case conclusion at this point. Obviously, it's fluid, things can change. As we know, electronic exports that come out of North Asia, particularly Korea and Taiwan, those companies also have a lot of production in China when it comes to memory or particularly low-end chip production. So I think, again, shifting that production is going to be difficult. As we know, when it comes to Brazil and Canada commodities, it's very hard to shift a steel mill. It's very hard to shift aluminium smelting plants. Obviously, North Asia, it's a lot more export dependent. But at the same time, those companies are a must-have in any condition. The more export-orientated countries are full of companies that are irreplaceable. Then you look at the ones that are that really where exports aren't important. I would say that India falls into this category. I would say that Southeast Asia, I would certainly say China falls into this category, where really it's more about domestic policy setting. In China's case, getting the property market right. India with continual infrastructure reform process. I think in those countries, from an investment or portfolio positioning point of view, we're really looking at more domestic policy and how that's impacting stocks. Those countries are also more full when you look at the composition of the stock market of domestic orientated companies. The number of companies that really have exposure in India to exports is actually reasonably low. In China, it's a little bit more balanced, but again, the majority of companies there are really affected by domestic policy, not export policy. So again, I come back to the fact that we're keeping our eye on things, but in terms of portfolio positioning, it really hasn't changed regionally or from a country perspective how we were positioned coming into the election. Yes, so I think the key drivers in terms of when we're looking at stocks and the key drivers of potential returns long term, continue to be first and foremost earnings. The geopolitical aspects of these markets have also played a significant role in the pricing of some equities in some regions, just because the noise has been so loud. But I would go further than that and say it's not as much the geopolitical setting as it is the domestic policy setting. So Chinese domestic policy setting towards Chinese property, I think in terms of a driver of return, a clearance in the property market would be, I think, provide a significant boost to stock market returns. In India, it's this, when it comes to domestic policy setting, it is the infrastructure reform, it's getting the budget lined up, etc. So again, when I say policy setting, I'd also put a more of an emphasis in terms of returns on domestic policy setting, rather than anything to do with US and US tariffs. So earnings are a key driver, but we have to acknowledge there has been an overhang geopolitically, but there also has been an even bigger overhang, I would argue, in terms of domestic policy setting, that in lots of countries needs to be cleared for returns to come through. Tariffs are important. They're an important consideration. We don't know the rates. We don't know the countries. We don't know the regions that are going to be more or less affected. But it's only one piece, I think, of importance.